Every investor has heard the seasonal rules for the stock market: when to buy, when to sell, which months to fear. But test them against 30 years of data, and most of them fall apart. We ran every trading day of the S&P 500 since 1996 through the TradeOdds database. Buy at the open, hold about a month, average every day. Here is what actually happened. Here is every month, ranked by how the next month played out. The greens are the strong months, the reds are the weak ones. A few of them are going to surprise you. The best month to buy? October. Up 2.25% on average, and positive more than 3/4 of the time. The month famous for crashes has quietly been the best month to own stocks. The worst month is not September, the way the folklore goes. It is February, the only month with a negative average in 30 years. September gets the bad reputation, and it is soft. Its win rate is the second worst of any month. But its average return comes out roughly flat, not deeply negative. The folklore points at the right season, just the wrong month. And sell in May and go away? That one is flipped. In the last decade, May and June were among the strongest months of the year, positive over 80% of the time. The real backbone of stock seasonality is the 6 months from November to April. They averaged about 1% per month, against 0.75% for the summer half. That gap is where sell in May came from. What about the Santa Claus rally, that 7-day window around year-end? It is real, but small. Positive about 74% of the last 31 years, for an average gain under 1%. A reliable tilt, not a windfall. The January effect? That is a small cap story, cash flowing back into beaten-down small companies at the turn of the year. For the S&P 500 itself, January is just average. The effect lives in the corners of the market, not the index most people hold. Here is the part the tidy tables skip. Seasonality drifts. Run the same test on just the last decade, and the ranking reshuffles. So a base rate is worth rechecking on recent data before you lean on it. So what do you actually do with this? Not much on its own. A month is one weak factor among many stronger ones. Where it earns its keep is as a tiebreaker, not a trading system. And be honest about the size of it. Even the best month is only a 1 to 2% tilt. October typical year still swings from -3 to +7. The calendar is a nudge, not a signal. What actually moves the odds is not the month. It is the setup around your entry, the market regime, the pullback, the conditions on the day. That is the edge worth measuring. That is what TradeOdds does. Layer on up to 17 factors: regime, trend, and momentum, and get the historical odds for any stock in seconds. Free to try, no account needed, at TradeOdds.io.